Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Unit Trust Research. Today, we will be looking into some key points which signal the recovery of Eurozone's economy and some challenges ahead. With Euro area manufacturing expanded for a fifth month in November, stock markets and confidence improved. It seems that most consensus are pointing toward that the European economy is underway to pull out of a recession despite a feeble one. However, with the new job figures and signs of deflationary risk, markets are once again skeptical. Eurozone unemployment in August was revised up to 12.2% from 12% and remained its stance in September. Although October's unemployment rate was down for the first time in 3 years by 0.1 percentage point to 12.1%, but it barely indicates a significant improvement. Consumer prices in the euro area rose by 0.7% only in the year through October, the slower pace since 2009. Although the November's inflation rate is estimated to rise to 0.9%, but it is still well below the European Central Bank's target rate of around 2%. The European Central Bank, ECB, in September announced their predicted inflation of 1.5% this year and 1.3% in 2014. It added on commenting that there is a subdued outlook for inflation in the 17-strong euro area. With deflation risk materializing in the Eurozone, ECB cut its main refinancing rate to a record low of 0.25% earlier in November. Further to that, ECB stressed its readiness to cut borrowing costs further and is technically prepared to make its deposit rate, now at zero, into negative territory. This may involve charging banks a fee to hold their money overnight and hence could possibly encourage banks to lend more and easing deflationary pressure. As much as many euro countries want to declare an end to recession, with the heterogeneity euro economy recovery and stubborn unemployment rate, in addition to easy monetary policy, deep structural reform are also required to raise the potential growth rate, prevent deflationary pressure from hurting the economy outlook, and to ensure a sustained economy recovery. Eurozone finance ministers gathered this year in Brussels for a first ever peer review of 2014 national budgets before being passed in national parliaments. This allows a considerable strengthening of the coordination and surveillance of budgetary policies within countries in the single currency area, and also further enhances the transparency of their economic policies. The growth versus austerity debate was renewed in this meeting. Under the Stability and Growth Pact, countries must not have deficits of more than 3% of gross domestic product and that of no more than 60% of GDP. Spain, Italy, and France were three of the nations singled out as part of the two-pack process. Spain and Italy have been warned that their budgets for 2014 are in breach of EU rules, while France has been warned of its economic reform plan and progress. Austerity policy has managed to prevent the collapse of EZ, but it has arguably brought the public finances and debt under control. Many argue that the higher taxes and public spending cuts have led to economic activity contractions and lower government revenues, while increasing welfare and support payments increases unemployment rate. Budget deficits, while smaller, persist and debt levels continue to rise. An economist at the European Commission analyzing austerity impacts on the currency bloc for the period between 2011 and 2013 has supported the argument by concluding that coordinated austerity in euro area countries did not just stifle domestic economy's recovery, but also deepen the crisis across the currency bloc. The Commission has then recommended that troubled countries, like Greece, to focus more on cutting spending rather than raising revenue through higher tax rates, and slow down on fiscal consolidation for several countries in the euro area. In view of the mounting concern that the austerity policies are killing off recovery, instead of austerity, perhaps the EZ needed a Keynesian change of direction instead. For example, greater public spending to shore up the Eurozone and avoid deflationary risks. The ECB acknowledged that it is essential to separate the responsibilities of the resolution and supervisory authorities. The Single Supervisory Mechanism, SSM, which is now in the form of the ECB, should be solely responsible for assessing whether a credit institution is failing or likely to fail, while the Single Resolution Mechanism, SRM, which is envisaged to become effective as of 1st January 2015, will provide a centralized decision-making platform on resolution matters without creating financial instability and provide a necessary complement to the SSM. Prior to assuming its supervisory role, the ECB has announced to conduct another round of comprehensive bank stress tests, covering 128 banks and about 85% of the assets of countries in the SSM. And it is expected that the key parameters of the stress test exercise will be announced by end of January next year. Last but not least, EZEC are also considering cheap loans, or in another word, subsidized lending, to member governments in return for signing binding contracts on policy overhauls, according to an EU document. The proposed initiative will form a mechanism for fiscal transfers and to move Eurozone closer as a fiscal union. The loans would be offered at a lower than market interest rates with economic reform targets and milestones that trigger the payout of tranches of the agreed loan. If the contract is breached, the EZ could suspend payouts or even ask for its money back. However, the document lacks details on the time frame which the loans would be offered for, the size of the loans, which is uncorrelated with the cost of reform, and the refinancing of such an instrument. While the detailed framework and process for comprehensive reform are yet to be finalized. Looking forward to 2014, expectations on structural reforms fueled investors' confidence and bodes well with an improving growth outlook. Now, for the Q&A section, we review a question that Joanne posted to us via Facebook. This is the question posted. The Eurozone's economy has been shaky for the past 3 years since Europe entered into financial crisis. As an avid EU market follower, the question that is pondering in my trading decisions lie on, is the region's economic crisis over, and will there be a relapse into recession? And what is the growth outlook of the European economy for the year of 2014? We are cautiously optimistic that the currency bloc is underway to exit recession. According to the new forecast from the European Commission on November 5th, across the 28-strong European Union, GDP will remain stagnant for 2013 as a whole, after declining 0.5% last year, and will then expand by 1.4% in 2014. The core engines behind the EU's recovery will be the combined growth of Germany, Britain, and Sweden, accounting expected growth of 1.7%, 2.2%, and 2.8% respectively. Meanwhile, amongst the financially distressed nations, Italy and Spain are expected to have a modest return in 2014. Unemployment in the EU as a whole is expected to improve slightly to 11% in 2014 from this year's 11.1%. While the recession may be over, the fundamentals have yet to confirm the exiting of the crisis. The toxic link between distressed banks and distressed governments remain as banking reform is stalled. However, with ECB determined to conduct a year-long review of Eurozone banks' finances and continue to encourage banks to improve the robustness of their balance sheets, banks could start to regain confidence from the investors. Not confining to banking reform, a more coordinated approach to macroeconomic policy with the interest of the wider euro area is also required to exit the crisis. Barring from political pressures, the pursuit of more encompassing macroeconomic adjustment rules will create a more integrated monetary union as well as achieve a higher and sustainable growth. Look forward to next Monday's topic, where our investment analyst will talk about the Singapore telecommunications sector. We want to hear from you. Any questions or comments on this topic, please drop them via PhillipCapital's Facebook and Twitter using the hashtag #TalkToPhillip. That is all that we have for you today. Do stay tuned to the next Weekly Market Watch. Thank you.